So this is April 2023. April 2023, question 5. So that is last sitting. April 2023. Barbara is requesting someone to share the past paper. So Brandy, can you share the past paper in the group for the benefit of Barbara and any other person who may be missing the past paper? Kindly. So I hope that has been done. That has been done. So let's read that question. Let's read the question. It says, the following. Oh, Brandy, I thought you were sharing. Or just take Brandy Piana. Nani anaweza kuwa nayo. So whoever has can share, or you just take a picture of last sitting question, then you share. Please let me know when that has been shared, kindly, or only that question, so that to songe. Chap chap. Yeah, it has been shared. Thank you. So let's read this question. It says, the following draft consolidated financial statements were extracted from the financial records of G Group for the year ended 30th September 2022. Okay. No problem with that. So we have the consolidated statement of profit or loss, as you can see there. Then also we have the statement of financial position. Additional information, number 1, the property, plant, and equipment comprised the following. So there was cost, provision for depreciation, carrying amounts. No problem. During the year ended 30th September 2022, G Limited disposed of an item of equipment for cash proceeds of 260. The equipment had cost 750 million and had accumulated depreciation of 370. Any gain or loss on disposal and depreciation on property, plant, and equipment is included in cost of sales. On 1st of January 2022, G Limited acquired 75% of their 100 million ordinary shares of shillings 10 each in S Limited. The acquisition consideration comprised a share exchange on the basis of 2 shares in G Limited for every 3 acquired shares in S Limited. G Limited was also to pay shillings 810 million to the owners of S Limited on 1st January 2023. G Limited's cost of capital is 8% per annum. Okay. The market value of the ordinary shares at 1st January 2022 were shillings 30 million, were shillings 30 and shillings 20 for G and S Limited respectively. The fair values of assets and liabilities of S Limited at the date of acquisition was as follows. So property, plant, and equipment, when they were, sorry, I don't know whether I mentioned this in the last class. If I did not, allow me to mention. Cash flow in this level is either a cash flow where a subsidiary has been disposed of or a subsidiary has been acquired. Don't expect anything less than that. That is the kind of cash flow we are dealing with in this level. And that is what makes it to be the advanced cash flow. So you check acquisition or disposal of a subsidiary. So for last sitting, the examiner brought a question where a subsidiary has been acquired. So when the subsidiary was being acquired, property, inventory, receivable, current tax, refundable, deferred tax, asset, trade payables of that subsidiary, as you guys can see. The group's policy is to measure the non-controlling interest in subsidiaries at fair value at acquisition dates. The market values of the subsidiaries' ordinary shares considered to be representative of their fair value of shares held by the non-controlling interest. Investment at fair value through profit or loss consists of highly marketable and risk-free securities held by G. Any impairment loss on goodwill is included in administrative expenses. Required consolidated statement of cash flow for the year ended 30th September 2022 using the indirect method. So in this level, your cash flow someone mpaka mwisho. They normally dictate the method they want you to use. So if you want to cash flow, then you can end up using a wrong method. So they have said we use indirect method in accordance with that, 20 marks. So now, there are some workings in cash flow which are standardized. You need to check those workings. One, you need to check depreciation for operating. In fact, let me give you those workings, which working you are supposed to be very keen on. So for operating activities, the key workings and operating activities, you need to check depreciation, you need to check depreciation, you need to check tax paid. You need to check tax paid. So for operating activities, those are the key. Some might be there. There are some workings which might be there, but the key workings are normally these two. When we go to investing activities, the key working under investing is always property, plant, and equipment. That is the key working under investing. So that investing, you do those, you reconcile PP to check acquisition or disposal of an asset. Either, examiner will give you one, acquisition or disposal, then you reconcile to get that other one. Then in financing, the workings you're supposed to do is for ordinary share capital to check whether you issue of shares. Also, you are supposed to reconcile retained earnings account to get dividends to holding company. You are also supposed to reconcile NCI account to get dividends to NCI. Those are the critical workings. Some might be there, but in cash flow at this level, these are the key and core workings you need to know. There are always 1, 2, 3, 4, 5, 6. Those 6 are the standardized workings which you need to familiarize yourself with. So once you know them, you are safe. Those are the key workings. I'm not saying they are the only, they are the key. Hizo zingine ni kidogo, you can maneuver. To have that, Have that. So I want us to start. In fact, I always prefer we do them in that order. We do them in that order. So our working one is going to be about depreciation. Our working one. Hapo kwa operating ongeza ingine moja, impairment. Impairment, very critical. Impairment is very critical there for operating activities. The system of depreciation is impairment. So impairment is also a critical working and operating. So operating, we need impairment. Actually, there should be 7 working, yes. So allow me to start with depreciation. So working one, but also we can be smart. We can be smart. You say working one, PP and depreciation. You can, those ones you can combine to make your work easy. You can combine those two, PP and depreciation. So right here, depreciation, PPE. Your arrangement is up to you. You can arrange, you can start with any. So I want to check depreciation for the year. This one I want to check whether they acquired or they disposed, PPE. So we start. Balance brought down. Balance brought down. For PPE, bring the net book value, not cost. Bring the net book value. So, this one you got. So now, PP, check additional information number 1. Check additional information number 1. PP at net book value, opening was 14,750 and accumulated depreciation was 15,250. I hope you are able to see the figures. Additional information number 1. So depreciation was 15,250. PP was 14,750. That is the accumulated depreciation and also the net book value of PPE. I hope you can see those figures. Then now you go to the notes, you try to adjust what might affect the PPE. Let's go to note 1, the other side. They disposed of an item of equipment for cash of this. The equipment had cost 750 and accumulated depreciation of 370. So disposal, the asset which was disposed had already depreciated by 370. From what they have said, there was accumulated depreciation on disposal of 370. But remember, 14 is net book value. So when you are subtracting from PPE, also you subtract the net book value. So you will take 750 minus 370. 750 minus 370. How much is that? So this will be the net book value which we subtract this side. Because we are dealing with the net book value. If you are dealing with cost, you subtract 750. But we are taking the net book value, so you subtract cost minus this to get the net book value. How much is that? Tujaribu kuchapa mbio mbio because of time. Hiyo swali inakaa refu kivyake. 380. So this is 380. You subtract. Haya. Let's continue. Note number 2. They acquired a subsidiary. There was acquisition of subsidiary. Subsidiary also came with PPE. So the subsidiary is called G Limited. So subsidiary, the subsidiary which came, they came with accumulated depreciation of 29. You add because the subsidiary has been acquired. But now the net book value will be the cost. The cost they said was 5 minus the accumulated of 29. So this one comes to 2100. The net book value of the subsidiary which has been acquired, that one comes to 2100. Like that. I hope you are following keenly, because subsidiary was acquired. Note 3, NCI, leave it alone. Investment, we don't want. Impairment, we don't want. So, so you come here and say depreciation for the year. Depreciation for the year, balancing figure here. Balancing figure. Then in note number 1, we saw that already there was disposal. So from there you can tell, you don't wait to be told. You can tell that direct your balancing figure is going to be acquisition. Acquisition, also balancing figure. Also balancing figure. Acquisition, because already we had disposal. When you have disposal, your balancing figure will be acquisition. If we had acquisition, then we were looking for disposal. So have here balance carried down, balance carried down. So check note 1, the breakdown in note 1 for the closing balances. So we start with the depreciation. So depreciation, balance carried down. I just want to check how together we are. How much is the balance carried down for depreciation as per note 1? As per note number 1? $19,500, correct. 19,500. So to know the charge for the year, actually we could have adjusted this one to make our work easier, but still there is no problem. Check 15 to 50 minus disposal plus the subsidiary. Then the increase, it will be an increase. The increase is the charge so that it tallies. So take this minus this plus this, then get the difference with this. That balancing figure is the depreciation charge. It is how much? How much is that? 1720 Halima. So 1720. Here you bring 1720, but you subtract. Depreciation is supposed to reduce the value of the assets. PP should be reduced with the depreciation. So here you add, fine, because it is the depreciation charge for the year, but this other side you subtract, reduce this. Then the net book value, closing net book value, you should see 23,500. So to get acquisition, take this minus this plus this minus this, compare with this. Your balancing figure will be in the acquisition. So give me acquisition there. Give me the acquisition there. So nimefanya 2 workings in 1. The acquisition there will be how much, dear students? Chop chop. Acquisition, Halima is giving, and okay, 8750. 8750, full stop. So that is it. We have gotten that. Unless someone has a question. In fact, we have done 2 workings in 1, depreciation and PPE. But down here, I can analyze something. Read the last bit of note 1. The last bit of note 1. Ile cannot before note 2. Any gain or loss on disposal and depreciation is charged to cost of sales. So let's check whether we gained or we lost. Let's check whether we gained or we lost. So this asset which was disposed, disposal, its net book value is this one here, the 380. Net book value is after cost minus the depreciation. So the net book value of the asset disposed was 380. However, we sold that asset for how much? Somebody? How much did we dispose that asset? How much did we dispose the asset in that note? Yeah, Barbara, we disposed it at 260, meaning we lost. So loss on disposal, it might be relevant. It will be relevant ahead. Loss on disposal of PPE is going to be 380 minus 260, which is 120. So when we require the loss, that is what we will capture. That is what we are going to capture. Correct? Good. Alright. So the next working, which I want us to do for operations, I wanted depreciation, but I've combined depreciation with the PPA, so that is okay. So I want us to do taxation, tax paid. So taxation there, taxation. So I want to check in cash flow, you try to check the tax paid. Kuna mtu naona anajibu answers hapa anaitwa Destiny section 5. So I think there are some people in the class. Is that true? There are some people in class using the class computer. Is that true? Inaweza kuwa ni hao watu ndio log in using the computer. Is that true? Yes. How many people are you? I'm just curious to know. How many people are you there using the computer? One. Is everything okay there where you are? I don't want to ask who you are. Are you comfortable? Is the class flowing? Perfect. No, away najua uko kwa class. Why are you saying yes? So everything is perfect. Let's proceed. So taxation, we want to check tax paid. Tax paid, so many students wanapatanga hiyo kitu wrong, but it's very easy. Nyinyi unajua nyinyi Team Alliance. Team Alliance wafai kuenda wrong. It's very easy. To get tax paid, you say balance brought down. Balance brought down. You combine both deferred and current. Kindly. Both deferred and current. Both deferred and current. So check deferred tax at the beginning. Just to confirm how together we are. Just to confirm how together we are. How much is the deferred tax at the start of the year? If you give me that, I pick the current. How much is the deferred tax at the beginning of the financial year? Beginning of the financial year. Beginning of financial year. How much are you seeing as the deferred tax liability? Mercy, 450. Alima, yes, it is 450. So you combine both deferred and current at the beginning, both deferred and current. So deferred at the beginning, we have 450. Current at the beginning, also check current liabilities, you'll be able to see 580. So combine those two. Combine those two. How much is the total? 9 all Shafika 10. 580 plus 450 will give you how much? When you add the two, what do you get? You get 1030. So at the start, the interpretation means at the start you had a tax liability because all this we have seen them to liabilities. It means at the beginning of the year, you had a tax liability of 1030, which you have not paid. Then for the year, so this for the year is the one people normally forget. You add for the year, check P&L, check profit and loss account, check profit and loss account. In the profit and loss account, P&L, I'm able to see income tax expense of 880. Please check to confirm. Income tax of 880. So you add. Some students normally think that that one has been paid. We normally work on accruals. You charge whether paid or not. So liability at the beginning was 1030, for the year 880. Check subsidiary, whether subsidiary came with some tax. So subsidiary should, what makes this question to be advanced is that subsidiary. So make sure anything you are doing, what I say kwa Kiswahili, chochote ufanyacho kwa hii cash flow, subsidiary should be a concern to you. Everything you are doing subsidiary should always be in the picture. So subsidiary, current tax, refundable, deferred tax asset. So remember, this is a liability. So refundable is a tax credit. When you have a tax credit, you don't add it to liability. It should reduce your liability. So we will have added if there were tax liabilities, but these are refunds and assets. So utilize the refunds to reduce the liabilities. So subsidiary, current, they had a current refundable of 20 and deferred tax asset of 110, meaning there was 130. So utilize this 130 to reduce the liability because these are refunds. Tax assets should not be added to the liabilities. So utilize them to reduce the liability. Therefore, we are expecting a total tax of how much at the end of the year? That should be our tax. So if we compare with the closing, we get the same figure, means they never paid. So that plus that minus 130. I hope you have understood why I'm subtracting 130, because they were tax credits. Refund and asset, those are tax credits. So I'm getting 1780. People are giving me 1780. Your balancing figure is going to be the tax paid. Tax paid is going to be your BF. BF is the balancing figure. So that one you will get by comparing with the balance carried down. So carried down, also you add deferred and current, closing. So just go to non-current liabilities, you check the closing, deferred and current. So deferred closing, I'm seeing 620. Current closing, I'm seeing 745. 745, like that. So add the two, what do you get? 1365. 1365. So this decrease, it was supposed to be 17. It has gone down to 13. The decrease from 17 to 13 means we have paid. A decrease in liability means payment. So take 1780 minus 1365. Tell me what you are getting, Halima. 415. So tax paid is 415. Good. So that is gone. Working three, impairment. I said impairment is very critical for operating activities. For operating, impairment is very critical. So impairment is quite long working because it will be two tiers. Tier 1 is to get goodwill on acquisition of this subsidiary. Tier 2 is to reconcile the goodwill account to get impairment. So I want us to start by getting goodwill. So right here, goodwill on acquisition. I want us to calculate goodwill on acquisition of this subsidiary. So goodwill on acquisition, check consideration. Consideration, we check where this subsidiary was acquired. We check where this subsidiary was acquired. Check note 2. On 1st January 2022, G Limited acquired 75% of their 100 million ordinary shares of shillings 10 each in S Limited. Okay. The acquisition consideration comprised a share exchange on the basis of 2 shares in G for every 3 acquired shares in S. G Limited was also to pay 810 million to the owners of S on 1st January 2022. That is next year. G Limited cost of capital is 8%. So consideration there are 2. 1, issue of shares. 2, 810, but you see 810 is not being paid immediately. Will be paid in 2023. So that is called deferred consideration because it will be paid in future. So consideration 1, issue of shares. Issue of shares. So they were issuing on the basis of 2 for every 3. They were issuing on the basis of you get 2 for every 3 acquired, but they acquired 75% times the number of shares. Shares, they said they were 100 million. They were 100 million. Then you multiply by the market value. Parent is the one issuing, so you multiply by the market value of the parent shares. The parent is giving 2 for every 3. So if you read paragraph 2 of note 2, the market value of ordinary shares at 1st January 2022 was 30 and 20 for G and S. So you multiply by shillings 30. You multiply with the price of the acquirer, the market value, not par value, the market value. So give me that figure. Give me that figure. How much do you get? $1,500. Then there is deferred. Deferred consideration. Deferred consideration, they are saying they will pay 810 next year, January. So you will check 810 times 1.08 raised to power negative 1. You know, we have to discount. The cost of capital, they said was 8%. So you will take 1 plus R raised to power negative n for discounting purposes. So that's why I'm taking 1.08 because cost of capital they have said is 8%. So you take 1.08 negative 1 times 810. Do for me that math. What do you get? We can round off if they are decimal. What do you get? $750. Then fair value of noisemakers NCI. They were mentioned somewhere. Fair value of NCI. Fair value of NCI. That was mentioned in note number 3. Let's read note 3. The group's policy is to measure the non-controlling interest in subsidiaries at fair value at acquisition dates. The market value of the subsidiaries' ordinary shares are considered to be the representative of the fair values of shares held by non-controlling interest. So non-controlling interest are holding 25%. You know, hajasema lakini wamesema 25% times 100, but 100 times shillings 20. The shares of the subsidiary had a market value of 20. In your parent issuing, but minority are in the subsidiary. So use the share price of the subsidiary, which is 20. So 25% of 100 by 20. What do you get? You get 500. Then, don't want to waste a lot of time. Less net assets. Net assets in this case, examiner didn't bother. And in cash flow, they will not bother to tell you to be ordinary on acquisition, retained earnings, apana. Check note 2. The very last bit of note 2, they acquired assets and liabilities. So they took the PPE, they added inventory, they added trade receivables, they subtracted payables. Then they got a figure there of 2,500. I hope everyone sees that 25. That 25 is the net assets for acquisition. They took all the assets. Assets minus liabilities is net assets. So there is no need of disturbing yourself adding equity component. So you take those assets minus liabilities, which is 25. So net assets is 25, meaning that goodwill will be how much? You take that plus that minus 25. That is our goodwill. So goodwill, people are saying goodwill is 250. Goodwill is 250. But now I want us to calculate impairment. So impairment, you can only determine impairment by reconciling goodwill account. So in the same working, you say down there, goodwill account. It is always 2 workings. So goodwill account is what is going to help you get impairment. So you will say balance brought down. Balance brought down. Balance brought down. Check non-current assets, goodwill. Go to the balance sheet for non-current assets. Good, 4140. So when you started the year, goodwill was 4140. You add the goodwill of the subsidiary. Subsidiary came with goodwill, the one we have determined, of 250. Balancing figure is going to be impairment. Impairment, that is the balancing figure. Because balance carried down for goodwill is 4,200. So how much is the reduction? The decrease is impairment. So how much is impairment? How much is impairment? The decrease. How much? 190. So that is how you calculate impairment. There is something I want us to do. Whenever you have deferred consideration, when you defer, there is always what we call accrued interest or accrued finance cost on deferment. When you defer, it means even that interest will not be paid. So I can just work it here, not a must, but just do it here. Accrued interest is going to be 8% of the amount. The amount is this one here, 750. The deferred consideration is 750. So 8% of 750. But remember, the acquisition was January. Books are being prepared in September. So for 9 months, it might help us ahead. So accrued interest is 8% of that amount times 9/12. So how much is the accrued interest? It might help us. Just have it. Just have it. Under working. So this was working 3-1. This is working 3-2. So that is 45. Thank you. Now, unajua sitaki watu wakae sasa mimi nitajua which working comes where. For operating activities, I want working for depreciation, which we did. Depreciation, taxation, then impairment. Those 3. We have done all of them. We have done depreciation, taxation, impairment you get by reconciling goodwill account, which we have done. Now we are going to the workings related to investing. Workings related to investing activities. Investing, you reconcile PPE, property, plant, and equipment. We combined them in working 1. There is no harm because nobody marks the workings. So we combined it in working 1. So hiyo tushafanya. So for investing tumemaliza. We are going to financing. Financing, focus on 3. Some might come in within, but focus on 3. Ordinary share capital, retained earnings, NCI. Those 3 workings. Correct. So come here and say working 4, ordinary share capital. Ordinary share capital and the share premium. You reconcile those 2 at once. People are ready? So you come and say, balance brought down. Balance brought down 15 plus premium. Premium was 3. So we are talking of 18. Then during the year, there are some shares parents gave out to acquire that company. So exchange, share exchange for acquisition. Share exchange for acquisition. Parents gave 2 of their shares for every 3 acquired. They acquired 75% of 100 at shillings 30. So they gave out 15. Check working 3, 1, 1,500. They gave out 1,500. Meaning that at the end of the year, shares should be standing at 19,500. Skip 1 line. Balance carried down, add is 20 plus 45. That is 24,500. So these people gave out shares for cash. So issue for cash is your BF. How much is that? It is 5,000. Is that 5,000? Yes. So this is 5,000. As simple as that. So ordinary is gone. We need to check retained earnings and noisemakers. retained earnings and noisemakers. Hi. Let me utilize this space. All right, so now we go to where? Retained earnings, but something is clicking in my head. For the first time, I just want to try out, because I'm trying to see how we can save on time, to combine retained earnings and NCI. So it's the first time I'm trying this. Let's see whether it will work. So working fine, retained earnings and NCI. Let me see how it can work. So have here retained earnings, have here NCI. Have it that way. All right, so we kick off. Balance brought forward. So balance brought down. Check under equity there. You'll see them. Retained earnings, I'm seeing 4340. 4340. While minority, I'm seeing 1080. Hope you can see the same. Hope you can see the same. You have seen that. For the year, add profits for the year. Add profit for the year. So retained earnings here, remember this is retained earnings to holding company. So go to P&L, kindly, tukimbia huko kwa P&L, huko mwisho. Profit for the year, the way we normally do group, once you are done, you share to holding and non-controlling. So the last bit of P&L, you will see attributable to the group owners, 2040. So you bring that one here. Group owners is the parent, we check it there. Then attributable to non-controlling is 520. You also bring it there, 520. Then minority for the subsidiary, add subsidiary will affect minority. In fact, I want you to tell me what we got. Which working was it? Working 3-1. Yes, working 3-1. What was the fair value of the minority in working 3-1? Check for me working 3-1. I might not have this now. How much was it? For minority, NCI, yeah, 500. So they got 500. Me, I'm not seeing anything else. There is nothing which will affect these two. Actually, there is nothing at all. There is nothing which will affect those two. Therefore, skip one line. Don't be skipping. Just say here, the balancing figure is always dividends paid. BF. It will be the balancing figure for each. Balancing figure for each. So balance carried down, check the closing balances. Retained earnings, when you check 1, 2, 3, 1, 2, 3, you will see 60, 10, 60, 10. Minority, non-controlling, you will see 18, 40. You will see 18, 40. So add this plus this, compare with the closing. The balancing figure is the dividends paid. This plus this plus this, compare with the closing, dividends paid. It has worked. In fact, I've saved a lot of time there. So give me the two figures. Give me those two figures. Umekaa sana? 370 to 60. Good. So this is dividends paid to holding company. This is dividend paid to NCI. Yeah. So ladies and gentlemen who are present, that is how we do. Those are the key and basic workings for cash flow. Hata hiyo utapatana nayo hapo isiku ya mtihani. Niwe kujipanga. There is one, I want to bring it here. But in the next questions, I will not capture it. It's something you can do during presentation. This being our first question, what are to humble? The working capital changes is the last one. Then we go to presentation. Yeah, lazima utengeneze sauti. Working capital changes. Working capital changes. Working capital are the inventory, receivables, and payables. Like that. So inventory, receivable, and payables, we are always checking for increase or decrease. Increase or decrease. Evo. People are ready? We start. Balance brought down. Balance brought down. Inventory, I'm seeing 76.60. Receivables, 70.10. Payables, 87.50. So what students normally forget, if you forget where we got here, subsidiary. So add subsidiary. Subsidiary. Check how much subsidiary came with. Inventory, they came with 820. Receivable, they came with 650. Payables, they came with 1200. Don't subtract that 1200 to become negative. Upper you become negative because we could not add it to those assets. It's a liability, but to each fellow liabilities, you just add. So the balancing figure will either be in or decrease. Increase or decrease, the balancing figures, so that we compare with the balance carried down. We compare with the balances carried down, like that. So balances carried down, be ready to give me the increase or decrease, which is the BM. So carried down, inventory, I'm seeing 89, I'm seeing 74.20, I'm seeing 97.90. Correct. So honorable members, give me the increase or decrease. Chap for the three. Presentation loading now. I'm waiting for the answers. If lazima ufanye working hapa, hii unaweza fanya huko kwa presentation. But for our first question, I felt it's wise to do it here. Halima, so someone will confirm Halima's figures, but Halima's given me just the figures. Hussein said inventory is an increase. So inventory is an increase of 20. Halima 250, 160. Are these two increase or decrease? Confirm. Kama ni increase, decrease tunaweka brackets. The last two increase or decrease. This one I've seen an increase. How about the last two? Or all are increase. Hapana, hiyo kwa. Hii ni decrease because it is 76. So this is a decrease. Here I'm seeing 99. This is also a decrease. So the last two are decrease. The last two are decrease. Correct. Correct. So we are done with anything called workings. We are done with anything called workings. I want us to go to presentation unless someone has a question. So you say there G group consolidated statement of cash flows for the year ended 30th September 2022. Please have that. Please have that. Receivables, people have said this is 240, not 250. So I will change. And see Monica and Brandy saying it should be 240. So we have changed. Be ready, be ready. Shillings are in millions. Shillings are in millions. So operating activities. Operating activities. So give me 1 minute. I want to talk to Mr. Wafula in regards to tomorrow's class for FM. I don't know that you need so that I will know how to plan my class after we are done with this class. Just a minute. I never got mwalimu on call, so venye tutapanga ndivyo tutaendelea. Haya, so we proceed. Profit before tax. Profit before tax. Kwa P&L, how much are you seeing? Profit before tax. So profit before tax, which people are saying there, 3440 is correct. Then you say adjust. Adjust for. So what do we normally adjust? We adjust for expenses which are non-operation. Pata hapo vizuri. Because hapo ukipata unapata hiyo swali vizuri. We adjust for expenses which are non-operation. Operating expenses are 3. Master that: administrative, cost of sales, distribution. Any expense which you will see in the entire question in the P&L or even in the notes, where kazi yako ni ku add back. They are non-operation, they should not be subtracted. They had already been subtracted prior to PBT, so you add them back. So check for any expense which is non-operation. Operations are 3: admin, distribution, cost of sales. Any expense appearing in P&L or even appearing in the additional information. Yeah, something went wrong. I lost you on the network. I hope everything is okay. Something went wrong somewhere. I hope you can hear me. There was lapse. I don't know what happened. I just lost you all of a sudden. Is everything okay? Yes, we proceed. So I was saying, what you adjust here is non-cash expenses. Sijataja mambo ya income. I'm coming to mention income. Non-cash expenses and non-operating expenses. Operating is administrative, cost of sales, and distribution. Any expense which is not those 3, you add them back. Number 2, you also bring income, which now you subtract. Subtract income which are non-operation. Operating income is only 1, sales. That is what we generate on daily operations, sales peke yake. Sales here, they will call it revenue. So that's the only one you spare. Sparing means you don't bring it here. Any other income you come across, whether in the notes or in the P&L, you subtract. That is how we do cash flow. We kick off. So in cash flow, immediately you write adjust for. Thinking begins after you have written depreciation. So write depreciation, working 1. I can't recall the figure, so please be on standby to help me there with the figures. How much was depreciation? How much was depreciation? Was it 1720? Am I 1720? I'm just remembering those answers. How much was depreciation? Yes, 1720. Bring the sister. The sister of depreciation is impairment. Impairment. Impairment, check working 3, 2. How much was impairment? Was it 190? 190. Add it back. Check for any other expense. Any other expense appearing in the notes, appearing in P&L, is all. So there was loss on disposal. Loss on disposal. Hiyo sijui kwenye tulifanya. Wewe uko nayo. Pale tulifanya PPE. I think hapo chini tulifanya loss on disposal. 120. I think it is working 1. That expense also you add back. Go to P&L. Go to P&L. From revenue, unipate? From revenue, unaenda. Your stopover, you stop at PBT, usipite PBT, usiteremke past profit before tax. So revenue top down, looking for non-operations. Operations 4, revenue, cost of sales, admin, distribution. Any other item from those 4, hata kama hujui what is that. If it was added, subtract. If it was subtracted, add back. Kwanza, top down, revenue, tick. Cost of sales, tick. Distribution, tick. Admin, tick. Fair value gain on short-term investment. Fair value gain. That is not an operating income. It is not an income generated on daily operations. 1 second. Toa. It was added. It is not an operating income. Finance cost. Finance cost is not an operating expense. 280. You add back. Tushafika kwa profit before tax. You are not allowed to go past that. Hivyo tu, hakuna story mingi. So adjust. So this is called, the name which is called is not very necessary for you. Otherwise, it is called cash flow before working capital changes. Cash flow before working capital changes. So you will add from 3440 back up. So tell me how much? How much, somebody? Lazima mpite mtihani. How much is that? 50. Halima is giving 50-20. Someone to confirm the same? Halima 50-20. Someone chap, time is not on our side. When you're talking it means people differs with Halima. 55-80, Mercy. Someone else? Susan 55-80. Halima, you check yours. 55-80. People are getting 55-80. Then bring working capital. Working capital. So working capital, you use the upper, not working 6. So increase in inventory, working 6 for 20. You subtract. When stock goes up, it means you are buying more stock. So there is cash commitment. Cash is going out. Receivables decrease. Decrease in receivables. Also working 6 to 40. That one you add. Decrease in receivable. Unajua receivable ni madeni. Deni zikipungua, it means wanalipa. You are collecting cash from customers. Then payables decrease. Decrease in payables. The same working. 160. You less. Decrease in payables means you are paying creditors. We unalipa, so pesa inatoka. That is all. So how much? 55-80 minus this plus this minus that. It's called cash generated. Generated from operations. Si lazima uandike hizo majina, but sawa tumeandika. Cash generated from operations. 52-40. $52.40. Correct. We proceed. Now you bring here tax paid. Nobody has a concern. So tax paid. I don't know if it was working. I think it was working too. Can you check? How much was it? Tax paid. I think it was working too, if I'm not wrong. Tax paid. How much was it? 415. 415. Then you wind it up by saying, I want to bring interest here. Interest, you can take it anywhere. The standard allows you to take it in any activity. Whatever your best. So interest paid . So interest paid will be this way. Angalia hapa. Interest is the finance cost, this one. So normally the same amount tumeweka hapa ndio tunakuja tunatoa. But in this question it will be different. You will take 280 minus there was accrued interest because there was deferred consideration. Can you go back and check for me that figure? There's a figure we computed on accrued interest. 45, note number. I think it was working 3.2. Working 3.2. There was 45 which was accrued. When you accrue, it means you have not paid. Otherwise, if that was not there, the way I normally give my deferred deposit for cash flow, you just take this 280, you subtract from there. But here there was accrued interest. So you take the total minus that 45. What do you get? 235. So help me with the cash flow from operating activity. So take 5240 minus 415 minus 235. What do you get? We are done with operating activities. What do you get? 4590. Thank you. We are going to invest in investing activities. Cash flow, ukifika kwa investing, PPE. Investing is all about non-current assets. Two things. One, cash received on disposal. PPE. You check PPE was disposed for how much? You check for me, but I recall it was 260. Can you confirm 260? Confirm 260. When we disposed our PPE note 1, was it sold for 260? Yeah, I remember it was 260. Check. Check to confirm. Note 1. Yes, Barbara, I've seen it. Then cash paid to acquire PPE. This was not given, but check working 1. We did it in working 1. We reconciled the PPE account. How much was it? How much did we pay to acquire PPE? So investing is all about those non-current assets. 8750. That is cash outflow because we paid. There is one thing which normally comes here, but here it is not around. So allow me to bring it. Cash paid to acquire subsidiary. Nothing. It was 810, but 810 was deferred to next year. It was deferred to 2023. So it has not been paid. Otherwise, if it was paid immediately, they can let happen. To that effect, there is nothing. Give me B. Cash flow ni tamu. Help us with B. How much will B be? Huh? How much is B? It will be negative, of course. Sasa ndio ni uongo, haiwezi kuwa kidogo hivyo 39. 8490 is reasonable. Negative 8490. Because in negative 8450 minus 260, shukaje mpaka 3000. So that is 8490. Financing. Financing activities. Financing activities. So financing, mambo ya shares. So issue of new shares. I don't know if this was which working. So you check, there's a working we did somewhere. I don't know, working 4, 5, somewhere there, 4, 5. Ordinary shares. We balanced and we realized the issue for cash. How much? Check you are working for ordinary shares. How much was it? 5,000. Cash inflow. These people paid dividends. So dividends to holding company and minority. Check that working. The second last working. The second last working. You can use commas. Holding, comma, NCI, that one. How much? You have those figures. 370 and 260. Thank you. Thank you. Go to non-current liabilities. Equity is over. Go to non-current liabilities. There's a working I never bothered. Go to non-current liabilities. You are seeing bank loan. Bank loan. Bank loan. So bank loan. Bank loan. You are seeing 3,000. 3,000 at the beginning. At the end, loan in equal 26. From your view as accountants, what has happened to the loan? When we opened the year, we are told loan was 3. Now the loan is 26. What has happened? Yes, Salima, we have paid. So that is loan repayment, correct? Repayment of bank loan. That is 3 minus 26. These people paid 400. There's something which was catching my attention, but I've noted why. Bank loan. There is deferred consideration at the end of the year. Kindly check. Deferred consideration at the end of the year, they are indicating 795. Can you tell me where the 795 is coming from? Though it's an issue, because deferred means hakuna pesa imelipwa. But the 795, you remember when we discounted the 810, we got how much? When we discounted the 810 to present value, what did we get? Yeah, we got 750. Then there was accrued interest. The accrued interest on deferment of 45. So 750 plus 45, that is how they got the 795. Which are these the only kitu ingine hapa? Give me C. There is nothing. There is nothing under financing which we have not captured. Which we have not captured. So help with C. How much, honorable members? 5 minus that, minus that, minus that. Susan and Hussein, they are saying 3970 positive. positive 3790, confirmed by many. Now you tell us net cash flow for the year, A plus B plus C. So can you add for me A plus B plus C? A plus B plus C. A plus B plus C. The net. You have everything. I'm just waiting for the answer. Kuna watu wanangoja tu mtu si post waone nikiweka. Weka hiyo umeshapata. Hiyo umepata ndio correct. Peperusha hiyo figure 70 correct. So 70 has been confirmed. Then you come here and tell us cash and cash equivalents. Cash and cash equivalents brought down. Then when you add, you will get cash and cash equivalents carried down like that. So that is the reconciliation point. That is the reconciliation point. So write for me our last working cash and cash equivalents. Write it somewhere there. Me, I will present mine up there. Cash and cash equivalents. Cash and cash equivalents 2022, 2021. Have it that way. And take a cash and cash equivalent 2022, 2021. We want to see whether it is reconciling. You have that. So go to current assets. Go to current assets. Go to current assets. There is investment at fair value through profit and loss. So investment at fair value. That is a cash equivalent. Investment, ideally, investment should be long-term. So any moment you see an investment being under current assets, it means it is short-term. It is short-term. So it's a cash equivalent. It can be converted very fast. Those are like bills. So this is 2570. This is 2400. Like that. 2570, 2400. Then there was gain. Check P&L. Check for me P&L. That is a tricky point there. Check P&L. P&L, there's somewhere they said fair value gain on short-term investment. So during the year, short-term investment we started with 24. During the year, there was a gain of 170. Actually, when you add 170 here, we have a 2570. So fair value gain 170. You bring it at the brought down so that it tallies with the closing. So 170. Cash at bank. Cash at bank. Cash at bank. We have 310 and 240. There was no bank overdraft. If there is bank overdraft, you subtract. So can you give me the two figures? Bio? Two figures. You have not given me the figures. You have not given me the figures. Brought down 28. You know, brought down is 2021. Hiyo mpangilio iko sawa. Inaanza 28 ama 2810. Which is which? Brought down is 20. You are supposed to start with 2021. Ukikuja hivi. So brought down is 2810. 2810. Then this is 2880. So now, when you want to know that you are correct in cash flow, you take this one. They brought down 2021, you bring it here. So let happen. 2810. When you add 2810 to 70, will you get your current down? That is how we reconcile cash flow. Do you get your current down? Yes, you get your current down. So 2880. It has perfectly reconciled. So that is how we do cash flow. So here, students only required 10 ticks to get everything. 10. So how do you get the 10? I know what students can get here. They will get this one here comfortably. I'm bringing things people will get comfortably. That one is gettable. This one, students will get. It's all to run like a mark. Those ones, everybody should get. So 1, 2, 3, and this one, 3, 4, 5, 6. 6. 6. Cash received on disposal, 7. 7. Then there is this one here, tax paid. Tax paid students, bado wanapata. Tax paid, so 7, 8. Without struggling, 8, this one is marked. One of these balancing figures are always marked. Lakini sasa hii ilikuwa na maneno mingi kuachana nayo. So without struggling, lakini you need to struggle. Without struggling, a student should get 8. 8 ticks. 8 is 16 over 20. One, ukipata 16 over 20, what else do you require? What else? That is enough. 16 over 20 is enough. You don't even need to struggle. You can struggle later. Write for me down there. Repeat using direct method. Repeat using direct method.
Wacha ndio sana. Sana ne.
So say there, repeat using direct method. Repeat using direct method. So allow me to give you the presentation of direct, then we fill in. They only differ in operations. Investing and financing are the same. So we are only repeating the operating activities only. Karen, Karen, do this, then you answer me before I answer you. Can you read the required, Yote, the required in that question? Required. Then once you tell me, then I will answer you. Chap chap. So G group. Karen, you have not answered me. Ukisoma required, wamesema which method in the required? You must answer that one. Then I answer you. Karen? Which method? Soma hapo required ya hiyo swali. As you tell me, let me write this. That Karen, now you are asking, but you don't want to answer. If you don't answer, then we are also not answering. Niambie required. The examiner said we use which method? You lazima uniambie. So the way you have said, it was a direct method. So Karen, you did. So I advocate. In fact, you might not be alone. I might repeat because some people are not there. For cash flow in section 5, you're required soma mpaka mwisho. Usione tu cash flow, then wewe umeanza. Sometimes wamesema which method to be used. So make sure umesoma mpaka mwisho, uangalie which method you want. Correct. So cash received from customers, you will bring cash paid to employees and suppliers. That one will be subtracted. Then you get cash generated from operations. Then you say tax paid, interest paid. Equal. Interest paid. So that you will get A. How that format? If format nagonga funny, it looks very short but very troublesome. The A which is here should tally with the A the other side. They should be the same. But it can be very troublesome sometimes. We kick off. Give me the two in form of commas. Tax and interest paid. You have them. You have them. Please give me these two. Tax paid and interest paid. You have them. Mahali. Niangalia hapo kwa working capital huko chini kwa ile format ingine. After working capital, was tax paid 415? Yeah, 415. This one will remain the same. 415 versus 235. Correct. So these two are what we require to confirm whether the A will be the same in both approaches. So let's start with cash from customers. How about working outside? So cash paid, no, received, sorry. Cash from customers. Cash from customers. So cash from customers. Cash from customers. You take receivables, wrote down. You add credit sales. Credit sales here we are going to assume to be revenue. Then what you get, cash received. Your BF, balancing figure. You compare with, sorry. I'm forgetting about subsidiary. Add subsidiary. Correct. Add subsidiary. Balancing figure will be the cash received. Cash received is the BF. So you check receivables. Receivables carried down. Like that. Like that. Alright, so let's fix up. Let's fix up very fast. So receivables brought down 70-10, which you can see with your own eyes. Credit sales assumed revenue 18,590. Subsidiary came with receivables worth 650. Closing receivables, we closed with 7420. The decrease is what we received. So this plus this minus that. Give me that figure. People are getting, right? I'm going to pay answer. Balancing figure there is how much? Umeanza kuchoka. How much is that? 18,830. That is what you bring here. 18,830. Back up. 18,830. I hope everyone gets that. I want to delete that one very fast. So we are going to employees. So say here, cash to employees. Employees, just bring admin or distribution. Let's start with the distribution, cost, and admin. Admin cost, expenses, administrative expenses. So go to P&L. Distribution is 1330. Admin is 2460. That is 3790. Then there are some non-cash expenses. There are non-cash expenses. Check note 5. Any impairment loss on goodwill is included in administrative. Less impairment. Impairment is inside. It's inside the admin. Impairment ilikuwa ngapi, students? Was it 190 ama? How much was admin? Remind me the figure of, impairment. What was the figure of impairment? Yes, 190. 36. So 36 is what we paid employees. 36 is what we paid employees. We want to know what we paid suppliers. Before you go to suppliers, there is something I want you to work out. Cost of sales. Before we enter for suppliers, for another cost of sales. Cost of sales reported. Reported the cost of sales, check P&L, 11 to 50.
Oh, so.
You kindly, Noah, mute. 11 to 50. Then I want you to read this note. Read for me. note 1, the last bit of note 1, the very last bit of note 1 in paragraph 2 there. Any gain on disposal and depreciation on PP is included in cost of sales. My depreciation and loss, they have nothing to do with the cash paid. So subtract. So depreciation was 1720. Was it 1720? Copy at laundries. Then loss was 120. There was loss of 120. So this is indicate. This is depreciation, this is loss. You need to subtract them. They are not part of cash paid. If you have confirmed that is okay, then tell me how much is the correct cost of sales. How much should it be? The correct figure. How much is it? $94.10. I want us to get purchases. Purchases is going to affect payables. So use this formula. Opening inventory plus purchases minus closing inventory to get P. So cost of sale is 94.10. 94.10 is equals to opening inventory. Opening inventory is 76.60 plus subsidiary. Subsidiary came with 820. 820 subsidiary plus P minus closing. Closing inventory is 8,900. So I need what my example. Here I want the value of P. Use that thing to get P. Lakini mnakaa sana sahi kunipea figures, you kama mmechoka. Get the value of P from your mathematical approach. From there, we are going to get what has been paid to suppliers haraka sana. Very fast. Very fast. For 20, basi ama hiyo for 20 ilikuwa ya kitambo. P is for 20. Hebu someone to confirm ama hiyo for 20 ni nini basi? Or I can work, then you tell me it is correct or not. So that is 76.60 plus subsidiary 820 minus 8,900. That is minus 420. Basi sasa hiyo yako ni mbaya. Then later hii side ingine 94.10. 98.30. Susan, tunafanya hesabu reverse. This is 98.30. P is 98.30. Yes, Brandy, you got it right. Susan, fanya hiyo hesabu vizuri. P is 98.30. So nachukua 276.60 plus 820 minus this. Then you add it to 94.10. Kisha. Oh, wewe umechukua from 410. Umeacha hiyo 9. Hiyo 9. Susan, hiyo 9 ile ya kufurahisha. I can tell that is what you have done. So P is 98.30. So to get cash to suppliers, this is now what you do. You take payables, wrote down, you add subsidiary, you add credit purchases. Credit purchases. We are going to assume that all these purchases were on credit, 98.30. We assume all of it was on credit. Then the balancing figure is the cash paid. BF, your balancing figure there, because you will compare with the balance carried down, payables. Payables carried down. With that, you will be safe. So how it then we just fix those figures, then we are done. So, good. Let's fix those figures. Chop, chop. So, payables down there, 8750. Subsidiary, the other side. Subsidiary came with 12. Check the other side. They came with 12. Current down payables, 9790. 9790. Question. Can you add and give me the balancing figure for suppliers? That is the cash paid. How much? 9990 as per Martin. And one person confirmed that. 9990. Halima has confirmed. Thank you. So to get the total, kuja kwa cash flow. To get the total, you take 9990 plus employees. Employees, we got 36. Employees, we got 36. So 9990 plus 36 is how much? 9990 plus 36. $13,590. 13,590. 18 minus 13, you'll get how much? 18 minus the 13. What will you get? 5240. 5240 minus 415 minus 235. What do you get? 4590. Is 4590 what we got the other side? For A of the other side, A for the indirect. Is that what we got? Halima, yes. Then there, NB, investing and financing activities are similar. Are similar in both methods. In both methods. Full stop. So you don't have to repeat those two. They are the same. So that is well done. That is well done. That is how that question for last sitting was supposed to be solved. In case they tell us this time around to go for direct, that is the route. Usipoambiwa direct, wachana na hiyo kitu. Inaanza kusumbua bure. But if it is said, everybody is there, so there is no problem. You only come here if it is required. If the question is open, you know, sometimes they don't restrict the method. Please always go for a direct method. I told you this weekend and next weekend will not be the same. So today, because you are now at par, you are at par with the evening class, Muko, the same place. I always meet them at 4 to 6, but because some of the evening students are working up around 4, I've talked to them. We shall meet this time for our next question. Hakuna time, so kama mtu bado anataka kwenda kutembea, wewe tembea tu, but make sure kwenye umestop unasoma. We don't have time. Time is not on our side. A lot of sacrifice is now required. So the next question, which we are going to solve, is August 2022. Question number 5B, page 18. So that will be our question in the evening class. Use the same login for that class, 6 to 8. We meet there. We are continuing with that cash flow. We are continuing with that cash flow. Take notes. So thank you. Have a nice day. We meet at 6 p.m. God willing.